If you are receiving Social Security or you are getting close to the age, there is a set of changes the Social Security Administration rolled out for this year that a surprising number of people have not fully caught up on yet. And depending on your situation, some of these changes affect how much money ends up in your account. So stick with this video because we are going to walk through exactly what changed, exactly what the new numbers are, and exactly what you need to check for your own situation, all pulled directly from the Social Security Administration's own published figures rather than guesswork or rumor. If information like this is useful to you, consider subscribing, because these thresholds tend to shift every single year, and staying on top of them is one of the simplest ways to avoid an unpleasant surprise on a benefit statement. Let's start with the change that catches the most people off guard every single year, and this year is no different, which is the retirement earnings test. Here is the situation this applies to. If you have claimed Social Security retirement benefits, but you have not yet reached what the SSA calls full retirement age, and you are still working, even part-time, there is a limit to how much you can earn before the SSA temporarily withholds part of your benefit. A lot of retirees assume that once they start collecting Social Security, that check is simply theirs no matter what else they earn, and that assumption is exactly what leads to confusion when a benefit payment comes in smaller than expected. For 2026, if you will be under full retirement age for the entire year, the earnings limit has increased to $24,480 annually. If your earnings go above that number, the Social Security Administration deducts $1 in benefits for every $2 you earn above the limit. Now here is a detail that trips up an even larger number of people, because as there is a separate higher limit that applies specifically to the year you actually reach full retirement age. If you are turning full retirement age at some point during 2026, the limit that applies to the months before your birthday is significantly higher, sitting at $65,160 for 2026, and for every $3 you earn above that higher threshold, only $1 in benefits gets withheld, which is a noticeably gentler reduction than the 2-to-1 ratio that applies before you hit that milestone year. And once you actually reach full retirement age, this entire earnings test disappears completely. From that point forward, you can earn any amount of income from work without it triggering any reduction in your Social Security benefit at all. This is one of the most persistent points of confusion in the entire system, because people frequently believe that money withheld under this earnings test is simply lost forever, and that is not actually how it works. According to the Social Security Administration's own explanation of this rule, once you reach full retirement age, your benefit amount gets recalculated to give you credit for the months where money withheld earlier, which means the reduction is essentially a delay in receiving that money rather than a permanent loss of it. Though I know that detail alone is not going to stop the confusion from happening every single year, because the mechanics of it are genuinely counterintuitive if nobody walks you through them clearly. There is an added layer of confusion that has been showing up more often recently, specifically for retirees who are self-employed, doing part-time consulting, running a small side business, or doing occasional freelance or contract work. The Social Security Administration does not only look at your total reported income when applying this earnings test, it can also evaluate what it calls substantial services in self-employment, meaning that even if your reported income looks low or inconsistent from month, actively working significant hours in your own business can still trigger a reduction, which catches a lot of retirees who assume that modest self-employment income automatically keeps them safely under the earnings limit. If you are doing any kind of self-employment work while collecting benefits before full retirement age, it is worth specifically confirming with the Social Security Administration how your particular situation is being evaluated, rather than assuming the dollar figure alone tells the whole story. There is also a lesser-known provision that applies specifically to people who retire partway through the year, often after leaving a higher-paying job earlier in the calendar year, and then starting to collect benefits mid-year. Instead of only applying the full annual earnings limit to your entire year of income, the Social Security Administration has a special monthly earnings rule that, in certain circumstances, evaluate your earnings on a month basis rather than purely as an annual total, which can actually work in your favor if significant income earlier in the year before you began collecting, since income earned before your benefits started a particular provision may be treated differently than income earned afterward. This is a nuanced area of the rules, and if your situation involves retiring mid-year, It is worth a direct conversation with the Social Security Administration or a qualified advisor to understand how the monthly rule would apply to your specific timeline, since getting this wrong in either direction can mean either an unexpected deduction or leaving benefit money on the table that you were actually entitled to receive. Moving beyond the earnings test, there is a separate number that changed this year that affects a different group of people, specifically higher income workers who are still paying into the system. The maximum amount of earnings subject to Social Security payroll tax, sometimes referred to as the taxable maximum or the wage base limit, increased for 2026 to $184,500. In practical terms, this means that if you earn above that amount in a given year, only the portion of your income up to that threshold has Social Security tax withheld from it, and any income earned above that limit is not subject to the Social Security payroll tax at all. This figure adjusts periodically to reflect changes in national average wages, and this year's increase means that higher-earning workers will see a slightly larger total Social Security tax contribution over the course of the year compared to the previous limit. This number matters for more than just current taxes, though, because your eventual retirement benefit is calculated using your average earnings across your highest 35 years of work, and earnings above the taxable maximum in any given year toward that calculation, which is part of why there is a hard ceiling on how large any individual's monthly Social Security benefit can eventually become, no matter how high their actual income was during their working years. Speaking of that ceiling, this year's adjustments also changed the maximum possible benefit amount someone can receive. According to the Social Security Administration's own published figures, the single largest monthly retirement payable in 2026, for someone who worked the maximum taxable income for at least 35 years and specifically delayed claiming benefits all the way until age 70, is $5,181 per month. For comparison, someone who worked that same maximum earnings history but claimed at their full retirement age instead of waiting until 70 would receive $4,152 per month instead, which illustrates just significant the difference is between claiming at full retirement age versus deliberately waiting the additional years until 70, when your benefit continues to grow through delayed retirement credits. It is worth being clear that these maximum figures represent a small minority of beneficiaries. Requires sustained maximum taxable earnings for at least 35 of a working career, which realistically rules out the majority of workers, and the more broadly representative figure is the average monthly 26, which the Social Security Administration has published at approximately $2,071, giving you a much more typical sense of what most beneficiaries are actually receiving on a monthly basis compared to the maximum ceiling figure that tends to get more attention in headlines. Now let's talk about a genuinely significant change that took effect this year involving how Social Security benefits get taxed, because this is one of the more consequential updates for seniors specifically. As part of legislation passed under what has been referred to as the One Big Beautiful Bill, a new temporary tax deduction specifically for seniors went into effect, providing a $6,000 bonus deduction for individuals age 65 and older. This deduction is designed to help reduce, and in some cases fully offset, the federal income taxes that beneficiaries pay on their Social Security income. To qualify for the full amount, you generally need to be at least 65 years old by the end of 2025, with a modified adjusted gross income up to $75,000 for individual filers or up to $150,000 for married couples filing jointly. There is also a reduced version of the deduction available for higher earners, phasing out gradually up to $175,000 for individual filers and up to $250,000 for couples filing jointly, above which the deduction phases out entirely. It is important to understand that this new deduction is provided in addition to the standard deduction seniors already receive under existing tax law, not as a replacement for it, so eligible seniors are generally able to claim both together. One detail worth flagging clearly, because it affects long-term planning, is that this particular deduction is not a permanent feature of the tax code. It is currently set to expire in 2028 under the legislation that created it. So if you are doing multi-year retirement income planning, it is worth factoring in that this specific benefit currently has a defined end date, rather than assuming it will continue indefinitely. There is also a broader, more structural conversation happening around Social Security that is worth being aware of, even though it does not require any immediate action on your part. The trust fund that Social Security relies on to pay full benefits is projected, according to current government estimates, to face a shortfall sometime around 2032. And if contacted before that point to address the funding gap, current projections suggest beneficiaries could see an automatic reduction in benefits, with some estimates describing a reduction in the range of roughly 23% if no legislative changes are made beforehand. This is not something that is happening right now, and Social Security is not disappearing. Benefits are still being paid in full today, but it is a genuine, well-documented long-term funding question that policymakers are actively discussing, including various proposals that would raise or eliminate the taxable maximum we talked about earlier as one possible way to increase revenue flowing into the system. If you are doing longer-term retirement planning, particularly if you are currently younger and further from claiming age, this is a factor worth keeping on your radar, not as a reason for alarm, but as a reason to stay informed as the policy conversation around it continues to develop over the next several years. There was also a separate and more immediate change that increased benefits for a specific group of beneficiaries this year through the Social Security Fairness Act, which affected people who had previously seen their Social Security benefits or eliminated due to also receiving a pension from work that was not covered by Social Security, such as certain public sector jobs, including some teachers, firefighters, and other government employees in specific states. That legislation increased benefits for many people in that category. So if you or someone you know falls into that specific situation involving a government pension that historically reduced Social Security benefits, it is worth directly checking your current benefit status, since this change may have already resulted in an increase you may not have fully accounted for yet. Pulling all of this together into something practical you can actually act on, here is what is genuinely worth doing after watching this. If you are currently working, collecting Social Security, and you are under full retirement age, confirm exactly which earnings limit is to your specific situation this year, the $24,400 limit if you are under full retirement age all year, or the higher $60,160 limit if you are reaching full retirement age at some point during 2026. And if you do any self-employment work on the side, specifically ask the Social Security Administration how substantial services rules apply to your situation rather than assuming your reported income number alone is what matters. If you are at least 65, check whether you qualify for the new $6,000 senior tax deduction based on your income level, and factor in that it currently has a 2028 expiration date if you are doing longer range planning. If you are still years away from claiming benefits, it is worth understanding how delaying your claim until as age 70 can meaningfully increase your eventual monthly benefit compared to claiming earlier. Since the gap between claiming at full retirement age and waiting until 70, as we saw with the maximum benefit figures earlier, can represent well over $1,000 a month difference at the higher end of the income scale. And even at more typical income levels, the percentage increase from delaying still meaningfully adds up over time. And if you or someone in your life previously had Social Security benefits reduced because of a government pension from non-covered work, it is worth directly confirming your current benefit status in light of the Social Security Fairness Act changes, since that is real money that may already be available to you. The most important overall takeaway here is that Social Security is a program with fixed numbers that stay the same year after year, the earnings limits, the taxable maximum, the maximum benefit figures, and now certain tax provisions specific to seniors all shift on a regular basis, some annually and some through new legislation. And the people who tend to get caught off guard are almost always the ones who assume the numbers they learned about years ago still apply today. The Social Security Administration does publish these updated figures directly on website every year, typically becoming available in the fall before taking effect the following January, and checking those figures directly or speaking with a Social Security representative directly about your specific situation remains the most reliable way to confirm how these changes apply to you personally, since every individual's work history, claiming age, and income situation genuinely does affect how these rules play out in practice. If this video helped clarify some of these changes for you, or for someone you know who is navigating Social Security right now, if them is one of the simplest ways to help someone avoid an unnecessary surprise on their next benefit statement. And if you want to stay caught up as these numbers inevitably shift again next year, subscribing means you will not have to go digging for this information yourself when the next round of changes gets announced.